everyone, welcome to Maven Money Talks podcast here with James Haas, our CFP. And, we wanted to put together a video because we know with the environment, the markets have been in here over the last 12 months, high interest rate environment. We've seen growth definitely slow down, and that's translating into companies, starting to do some layoffs. And so we thought it would be really important to make sure that people understand, what options they have when they're in a job transition, of whether you just change jobs on your own or if you were recently laid off. Obviously, we understand that people, need access to funds during that time. So we wanted to make, again, sure people were aware of all the options available and just give you some ideas to consider. And obviously, feel free to reach out to us if you ever have any questions or need anything. But James, are there a few things that are like kind of top of mind when what people should think through in going through a job transition or a layoff?
Yeah, definitely. Three primary questions that we typically get, you're very familiar with this as well, is who owns the funds that are in my current 401k plan for my company, what the access looks like for accessing those funds, whether it's leaving them there, taking them, rolling them over, a lot of different options there. And then we got a lot of questions about severance packages and the most efficient way to utilize your severance package. So from an ownership perspective, it's really important to understand that there is a total balance in your 401k plan, and then there's a vested balance. So those are two, sometimes those are different numbers, right? So the total amount that comes out of your paycheck on a biweekly or monthly basis, however often you're paid, every dollar that you put into the 401k plan is yours 100%. What you need to be aware of is profit sharing, a little bit of a different conversation. And so profit sharing is money that your company has a discretion to put in some years, not put in some years. They're essentially giving you a little bit of a bonus based on the profitability of the business, right? So that's the amount that you need to really take a look at and make sure that you have good understanding of what your vesting schedule might have been for those dollars. Because some companies, you're 100% vested right out of the gate. Other companies have a little bit more of a strict vesting schedule. So you just want to make sure that you have a good idea of what those funds look like and what your actual total amount is compared to your actual vested amount, which is the dollars that you can take with you.
Yeah, usually that's available on your statement too. So it'll show your contributions, and then sometimes company will have two different types of contributions as well, whether it's a safe harbor match, which is 100% vested, or profit sharing, which has that vesting schedule. And it will differentiate between the two on your statement. So again, if you're unsure, we have people email us statements all the time to review it with them and help them understand, what's available to them. So yeah, really important part.
Yeah, exactly. And then second part that I mentioned is accessing the funds. So you really get into a conversation of three different areas. You can leave it, you can roll it, or you can take it, right? So leaving it is you're just leaving it at the current employer's 401k plan. And there are positives and negatives with each of those strategies. And we can, if you have any questions on what those positives and negatives look like, feel free to reach out to us and we can kind of walk through each of those. But you can leave it at the current 401k plan for your current company or your prior employer if you've already left. You can roll the funds over, which means you can roll them into your new company's 401k plan if you've already found a new place of employment. Or you can roll them into an individual IRA account. And so, there are also positives and negatives to doing each of those things, both from a tax implication perspective and just ease of the process. So if you have questions, obviously reach out to us. We'd be happy to help you with that. And then the last option would be to withdraw the funds. And that really speaks to, like Paolo kind of touched on out of the gate, was if you need access to those funds in transition, not every situation is going to be the same. So some people might take a little bit longer in transition, depending on what the job market looks like, depending on what their cash flow needs are. So if you need to access those funds, make sure that you speak to someone from an advisory perspective in that situation, because there are efficient and inefficient ways to access those funds from a tax perspective, from a potential penalty perspective. So, we'd love to be a resource in those situations. So just let us know how we can help.
Yeah, I think to touch on the important parts of if you're doing a withdrawal, especially let's say you've been laid off and you need access to those funds for, living, right? So when you withdraw it just directly from your 401k, 401k plans are required to withhold typically 20%. So you're going to receive only 80% of your vested balance, and then that 20% is withheld for tax purposes. So that's going to be payable to taxes. Whereas if you do a rollover, it doesn't change the fact that you're still going to possibly owe taxes depending on how much you take out, but you can control your tax situation a little bit better because you're not required to do withholdings, and you could withdraw little by little from an IRA. So something that can be a little more strategic as opposed to just taking a lump sum distribution. Because, we've talked to people, I'm sure you have as well, when somebody takes out their funds and they don't end up using all of it, and then they set their retirement, savings back however many years they had put into their retirement plan. So trying to protect what you've done in terms of savings, but also to be understanding of the situation that you're in terms of needing financial stability, having an IRA where you're drawing out of that can make more sense and ultimately save you more in taxes and save you more from a retirement savings standpoint. So I think that's something that's really important, that a lot of people just kind of think one or the other, but there's a perfect middle ground that can help kind of be specific to your situation, what your income needs are, that should be considered.
Yep. And that's a conversation that we have on a regular basis with our clients, is trying to figure out what that kind of tailored strategy is for you, because like Paolo said, everyone's situation is different, everyone's transition looks different. So we love having those conversations to make sure that you don't take more of a tax hit than you need to, or have it be more expensive for the distribution than it needs to be. So yeah, we love having those kind of strategy conversations with our clients. Let us know how we can help.
Yeah, and a lot of times too, what you want to consider is, did your company provide a severance? Is that something that you want to take into consideration? You're going to have income coming through. If you've got additional income from the severance package, and then you take an IRA withdrawal or a 401k withdrawal, then that's going to be ordinary income for you, which can, again, just increase taxes. You're probably being paid out for PTO that's unused. So there's all these different things that you really don't think about in the moment, and there's a lot going on. So probably your last concern is taxes, but it's something that we want to make people aware of. Your first concern is, how do I pay my next bill? And that's understandable, but we want to, again, make people confident in the decisions that they're making from a financial perspective. And again, make sure that it is the smartest decision for them to really reach their goals, and again, maintain what's needed kind of in this period of transition that they're in.
Yeah, and to Paolo's point, from a severance package standpoint, so when you get anytime you get kind of a windfall or a large lump sum of money, it's really easy to think about a lot of the things that you want versus a lot of the things that you need to kind of check the box on. So a couple of good ideas at that point when you get that severance package windfall. First off is to make sure that you have a good idea of what's going on with your rainy day fund or your emergency fund, right? So they recommend general ideas between 3 to 6 months of emergency funds socked away, and that's total living expenses. That includes your mortgage or your rent. That includes groceries, entertainment, whatever it might be. And usually the first great step toward figuring out what that looks like is doing a budget. We call it a cash flow budget. No one likes the word budget because it means you don't get to spend money that you want to spend, but it's really good to do a cash flow analysis for yourself, because then you can figure out what you need to have in that rainy day fund. And then if you get a lump sum amount from a severance, you can carve off some of that and make sure that you're at least covered in that capacity. It's really important, especially, arguably the most important time to make sure your rainy day fund is appropriately set up is during a time of transition, because you've now turned off the spigot from an income standpoint. So you're more likely to have to rely on that rainy day account. So that's kind of first checkbox we would talk to somebody about from a severance standpoint. Second one would be doing a debt analysis for yourself. So there are good kinds of debt and there are bad kinds of debt, kind of in different categories. So a bad debt is a high interest bearing debt that like a consumer debt, credit card, that isn't really benefiting you in your life. A good debt is something that's improving your life, whether it's a mortgage, whether it's a car payment that gets you to your job, things like that. So doing a debt analysis and figuring out where you can earmark some of those severance funds if you have high interest bearing debt through credit cards, consumer debt, things like that. That's a really good opportunity to tackle some of those outstanding debts, help out with your cash flow on the other side to kind of, carve off some more of those funds from the severance package. And then the third option is kind of whatever else you need after that happens, right?
Yeah, no, I think we've touched on a lot of topics, and obviously for everybody's situation, it's going to be a little bit different based on their expenses, based on being single or married. So there's a lot that goes into it, and again, that's part of why we wanted to just put some things together that we really want people to be aware of and just understand before just making a decision without looking into it a little bit further. So hope you were able to gain something from this. Obviously, if you have any questions, reach out to us. If there's anything specific you'd like to learn about, feel free and let us know and put some comments in what we could provide in terms of additional topics. And hope you enjoyed it. James, thanks for the insights today,
Of course.
and appreciate it. Have a great day.
Thanks.